Welcome students. So next thing we will talk about is the next principle, that is the cash flow estimation principle, that is the incremental principle, right. So in the incremental principle we have to be very careful about that what happens to the cash flows of the firm, right. Maybe incremental analysis or incremental say principle will be applicable only on those projects which are being taken or undertaken by the firm, by the existing firms who have already their own businesses, they are existing in the market, but they want to add a new product or a new venture into their total product line, or maybe into their total product portfolio, or maybe into their total business portfolio. They want to add a new division, they want to add a new project, or they want to add a new product manufacturing or generation of any service. So that would be maybe say the additional investment they want to make apart from their existing investment. And there maybe if they add a new venture or a new product or a new project or a new business into their business portfolio, so that would impact their cash flows or their total cash estimates. And there the incremental principle plays a role that if we go for this venture or this particular say investment if we make in the market, so what is going to happen to the existing financial position of the firm or to the existing cash flows of the firm. But if the venture is new only for the first time, the entrepreneurs are also new, it's a kind of a startup, is going to come up for the first time on the say in existence or on this earth, and nothing is existing in the past. So for that kind of the investment decisions, incremental principle will not be useful. So only for those people who are already into the business and they want to grow with it, they want to add a new product, a new service, they want to set up a new division, they want to set up a new say a new venture, or they want to go for any kind of the expansion, diversification and growth of the existing business, then the incremental analysis would be important, or incremental principle would be very much applicable and very much useful. So to ascertain the project's incremental cash flows, you have to look at what happens to the cash flows of the firm with and without the project. If you add the project, what will happen? Your cash flows will grow, right, because the profitability will grow, cash flows will grow. So finally overall value of the firm will grow. Or it can be reverse also, that initial years, for example initial 5 years it's making losses, incurring losses. After 5 years it's expected to come on the break even point, and thereafter it will start earning the profits. So initial 5 years can be difficult for the existing firm. Its own financial health would be affected negatively because the new venture is making losses, and those losses have to be done good from the existing profits of the existing firms. So either way it has to be maybe looked at like either a good decision or a bad decision. So you have to look it at very carefully. You have to look it at that with the project and without the project, what is happening to the cash flow of the firm, right? Cash flow of the firm with the project and without the project, what is going to happen? You have to very carefully evaluate it. If you feel that say initial 5 years would be a difficult time, but after that there is a very good time because this product has a future, this service has a future, and we are going to make maybe losses in the initial years, but thereafter we are going to make the huge profits. For example, you talk about the say Jio mobile telephony. When Jio came into the market, it's already a maybe the business was existing, and it's one division of the Reliance Industries. They are into the new service area of the mobile telephony. So when they decided to move into the mobile telephony, Reliance Industries are already or were already into existence, and you see initial 6 months they gave the services free of cost. So it was free to the customer, but it was not free to the firm. When the firm has to make investment, they have to raise towers or they have to make huge investment into laying the network and then on other say investments. So firm was incurring expenses. Jio say this mobile was incurring expenses or maybe making investments, but it was free to the customer. So initial first 6 months it didn't give any cash inflow to the firm. So it means those months, those 6 months must have been funded from some source by the Reliance Industries or maybe by the say promoters of the Jio mobile telephone or maybe this mobile services. Reliance Industries was a major promoter, so they had to bear that want, they have to bear that maybe kind of the loss. So because only outflow is there, inflow is not there, so they have to make analysis. So they were very clear that yes, initial 6 months may be difficult for us, and they were even ready to extend the free services for the another 3 months also, but because of the restrictions imposed by the Competition Commission of India, they couldn't do so. Otherwise, they had made the estimates that initial 9 months we have to give the service free of cost, and after that we will start earning the good returns and the cash inflows will start. But they were very sure that mobile telephony is the future of India. It's a very large country, 150, close to 150 billion people. Now we are officially or unofficially we can say 150 billion people, large population. It's a growing economy, emerging economy, growing at a very faster rate. At that time we were the fifth largest economy in the world. Now we have become the fourth largest economy in the world, and very soon we may be third largest economy in the world. So income level of the people is increasing, businesses are growing, and people require more and more mobile but very efficient say mobile telephone services. People are ready to pay also. So they knew it that mobile telephony has a future in India. It will grow at a very faster pace because the population base is very say big. I think we are the largest population in the world now, and maybe have outsmarted China as far as the population is concerned. So Jio made a good analysis. Reliance Industries made a good analysis that initially the cash flows may be negative, but over the period of time they will become positive, and this sector is a growing sector, it's a value adding sector, and our cash flows though negatively will be negatively hit in the initial days, but later on we will have a very positive support of this venture when we will add into the project profile of Reliance Industries. Jio mobiles or mobile telephony will add a good value to the existing group, and we should go ahead with this. But if it is a new venture, startup, or maybe for the first time a group of entrepreneurs are moving into the business, then I think incremental analysis is of no use. It will not add any value. So incremental principle, we assume that yes, the business is existing business, the firm is existing firm, and they want to grow with adding a new division or a new product into their product line, and they want to set up a new venture, and they want to add some new say project into their project profile. So for that purpose we will have to say, we will have to evaluate it carefully and try to understand that what will happen to the cash flows of the existing firm with the project. Are the cash flows going to be positively impacted or negatively hit, or without the project what is going to happen? So with the project, is a positive or negative impact, and if we do not go for the project, still what is the level of the cash flows, and what is the impact upon the cash flows because of not having the venture and going on with the same project profile, or maybe the same product profile, or the same service profile, and same business profile. So with and without project we have to work out the cash flows, and we will have to see how it is going to impact the existing business of the firm, existing cash flows of the firm. So while talking about this incremental principle for the existing businesses, we have to use these guidelines. These guidelines are very important, and the first guideline is consider all incidental expenses. When you want to add up a new venture, there could be some incidental expenses which are going to impact the existing firm also. These incidental expenses would be say preparing the new project report for say setting up of a new venture, or maybe incurring some preliminary expenses, and then preparing some necessary company related records, memorandum of association, or maybe article of association and all that. So all these incidental effects will be taken into account. They will largely cause cash outflows. So we will have to see that since the venture is new and cash outflows will be coming from the existing firm, so how it is going to impact the existing cash flows of the firm when we are going to set up new venture. So for that purpose we have to consider all the incidental effects. Ignore sunk cost. This is a very important consideration here, important guideline. That for example, for developing a new product which you want to add now to the existing product line of the company, you have spent some research and development expenses, right? And those research and development expenses are very high. So if you want to recover those research and development expenses by selling the product in the market and calculating the cost of the new product per unit accordingly, then probably it will become non-saleable, because the cost will be very high, and the selling price if is going to be fixed on the basis of that cost, the product will become highly non-competitive and non-saleable in the market. So as a incremental principle, the guideline says that you have to ignore the sunk cost. For example, you talk about these pharmaceutical companies who are manufacturing different kind of the drugs, right? Different kind of the medicines, different kind of the drugs, and each drug is based upon certain molecules, because the basis of developing a drug is a molecule, and real drug is basically a molecule. When we have to develop some, say, medicine for the cure of any problem, any disease, so we will have to make a huge investment into R&D, and then we have to try to develop a drug. So we don't directly develop a drug, we develop a molecule, and that molecule has to be later on processed and converted into a drug. So developing a molecule, as per the Indian estimates, requires minimum 10 years period of time and about 15,000 crores of the expenses or the investment required. Even after that also, it's not certain that you'll be able to develop that molecule, you'll be able to get that molecule. But for example, if we are able to get that molecule, develop a drug, so would you add that 15,000 crore into the total cost of that drug when it will go to the market? Because at that time you will have the manufacturing cost, processing cost, and the sunk cost. So if you add up both the costs and then accordingly you fix up the price, it will be beyond the reach of the masses. So it will not become saleable. So you have to ignore the sunk cost. That is R&D expenses of 15,000 crores. They have to come from the other sources of the firm, or maybe from the reserves created for R&D purpose of the firm, and you have not to recover it from the, say, from the new drug which you invented and incurred that R&D expenses for a period of 10 years. For developing that molecule, that is not possible. So as a incremental principle, you have to assume and you have to agree that you have to ignore the sunk cost, because basically a sunk cost. You think that, for example, you are not able to develop the molecule, even then that cost will be incurred, and you are prepared that whether I get the molecule or I don't get the molecule, I will make this investment, I will go for this R&D investment, I will make this investment and get the drug. If you are able to get, fine. If you are not able to get, still you are going to make this expense, and you are going to not to recover it through selling the new drug in the market. So it's basically a sunk cost. It has to be ignored, and it has not to be taken into account directly to be recovered by selling the new product in the market. That's not going to happen. You have to recover it from some other sources, or you have to create some specific reserves in the, say, existing profit and loss appropriation account and then in the balance sheet, that these reserves are being created slowly and steadily by the firm, which will be used for developing the new products. And later on, when the product or that molecule is developed, this will be treated as a sunk cost. Include the opportunity cost. That's very important. Opportunity cost means when you add up a new project in the existing project portfolio or the product line of the firm, you have to, say, lose from something from the existing products or the existing services. So there is one thing. Let's say, one way of looking at the opportunity cost, that if you are doing this, you will not be able to do something else, right? It can be in isolation also. Something else means when you are taking out of the two projects, project X and project Y. If you are going to take up the project X, you will not be able to take the project Y. So if you are making this 10,000 rupees investment in this, you will not be making this 10,000 rupees investment in the project Y. So the benefits of 10,000 rupees investment in 10,000 will only be available to us, and not of the benefits of the second investment to be made in the product Y. So there is opportunity cost, that you make investment in one venture, so you lose the other venture, right? That's one part. Second thing can be that in this kind of the incremental analysis, when the firm is an existing firm, it has, for example, the different products in the pipeline. They are manufacturing 4 products already, X, Y, Z and A, right? You want to add now the new product in the total product profile of the firm. This is the product B. So in this case, when you are going to add up a new product B, it means you have to lose some part of maybe X, Y, Z or A. So that can also be called as opportunity cost. That maybe you have to divert some of the resources from the say X, Y, Z to A, or from X, Y, Z and A to B. So it may be from X to B, Y to B, Z to B, or A to B. We have to sacrifice some resources. So it may be some impact upon the existing production process of the existing 4 products. So we will have to take that also into account. And if there is no impact upon the existing 4, X, Y, Z and A, with the introduction of the product B, then there is no problem at all. But we have to think about it. So in that case also we will have to think about it, that if this 10,000 you invested in X, you could have invested in Y also. So you have to see here that what is opportunity cost, and if there is any loss because of the accepting the one product against the other, that will be one possibility. But in this case, when you talk about include the opportunity cost, it is more relevant in the second case, that when you are introducing the fifth product in the product existing product line of the firm, you are going to lose some of the output from the existing four products, and the loss of that means output because of the new introduction has to be taken into account. That is called as the opportunity cost. And question the allocation of the overhead cost. Yes, how to apportion the overhead cost. So it means if there is no you call it as the say additional overheads you are going to, special overheads you are going to incur. So in that case you have to proportionately distribute the total overheads. Now earlier they were distributed to the four products, now you have to distribute to the five products, because from the existing overheads the new product is also consuming some part of the existing overheads. But some special overheads, for example, if you are incurring for launching of the product B, then you have to add up those overheads only in the product B, not proportionately to the all existing four products. And estimate the working capital properly, right? This is another important principle, because most of the time it is seen, most of the startups fail because they never care for the working capital appropriately. Most of the entrepreneurs are interested in arranging for the long term funds, right? Long term funds, long term investments, they are very much interested that how much money is required for land, plant, building, machinery, everything they are more concerned about. And they forget or they commit a blunder that we require money for buying raw material also, we require money for paying expenses also, those utilities also, we need money for paying the wages of the workers also, we need to pay the salaries of the employees also, we need to pay for the power, water, everything. And when sufficient raw material is not available, sufficient utilities are not available, sufficient human resources are not available, in that situation even your long term investment also doesn't give you the best results. So if you are only concerned about the long term investments, not about the short term investment working capital, you are going to commit a blunder and the project is going to fail. So you have to be very careful that apart or besides making estimates for the long term investment, for the long term or the fixed assets, always carefully make proper estimates for say making investment for the working capital also. So if the working capital is sufficiently available, you would be able to make the proper utilization of the plant and the other fixed assets. And if you are able to utilize the fixed assets appropriately to the fullest possible extent, then overall firm is going to deliver the value to you. But just because of the want of the working capital or shortage of the working capital, if you do not have the funds available for say arranging for the raw material, paying the salaries and wages and maybe for the utilities, then your fixed assets would be underutilized and the value of the firm would be negatively affected. So always think about it, that when you want to go for, if it's a new venture, even in that case also, and if it's an existing venture and into the existing four products you want to add the fifth product, how much additional working capital would be required, always carefully make arrangement for that. If the working capital is sufficiently available, only then you can make the proper use of the fixed assets. Otherwise, fixed assets would be underutilized and the value of the firm would be negatively hit. So be careful about that. Next thing is the post-tax principle. Whatever the cash estimates or cash flow estimates you are going to make, they would be post-tax only, right? They'll be after tax, whatever the cash is available. Means when you're going to talk about the profit, because profit is the first source of the cash flow. So when you're going to talk about the profit, you will take the PAT, profit after tax. Into this profit after tax, you will add all plus non-cash expenses. Into this, you will add the non-cash expenses, like it can be depreciation, amortization and others. So PAT plus non-cash expenses is going to give you the proper estimation for the cash flows. So whatever the cash flows you are going to work out, cash flows should be measured in a post-tax basis. It's very clearly mentioned here that because profit after tax is the first source of the cash flow, so it has to be taken the profit after tax. So post-tax principle becomes important for us. And marginal tax rate of the firm is relevant. rate, right? Marginal tax rate of the firm is the relevant rate for the estimating the tax liability of the firm. So you have not to take the static say tax rate. We have to take the marginal tax rate, because as the income of the firm increases, the tax rate also becomes marginal. Marginal, that for example, as we have seen in the direct taxes also, that for example 0 to 3 lakh rupees there is a different tax, right? From the 3 lakh rupees to the 6 lakh rupees there is a different tax, right? So like this, it's called as a marginal tax. So the moment your sales keep on increasing, right? So the tax also keep on rising. So we will always use the marginal tax rate, not the static tax rate or the fixed tax rate. And whatever the say the profit we are going to take, or maybe the source of the cash flow, the first source is the profit we are going to take. That profit will be PAT, profit after tax, not profit before tax. And into that profit, when you are going to add up the non-cash expenses, so that would be called as the total cash flow available with us, or the net cash flow available with us. So initially we will have the annual cash flows, and in the last year of the project we will have the total net cash flow, that is the annual cash flow plus the terminal value of the project. So that will give us the total cash flow. So when we will practically work out, we'll do illustration at the end of this discussion. You would be very clear that how to use the post-tax principle and how to calculate the cash flow on the basis of the profit after tax, or maybe calling it as a post-tax principle. Then is the next important consideration is the treatment of the losses. It's again a very, very important thing. Because initially when you set up a new venture, new project, initially it gives us a losses. So we have the two kind of situations. First situation is that the firm is only a standalone firm. For example, this is a standalone project and it is not, means nothing is existing in the market already. It's not as a new project by an existing firm, but it's a new project by a team of the entrepreneurs, or by the, so you call it as the promoters, and they have set up this venture. So how to treat the losses in that case? So we will have to treat it differently in that situation. But if it is uppercase like that, for example, it's a project by some additional maybe by existing firm, additional investment by the existing firm. So in that case we are going to understand it under the scenario, say number one, project, and then firm, and then the action, to understand the treatment of the losses. So for example, you say that the firm is existing already and they are making addition into their existing project profile. They are adding a new venture. So maybe in the existing 4 products, they are adding a 5th new product also in the existing product line of the firm, and for that purpose they are setting up a full-fledged new venture, new project they are going to set up. Then how to treat the losses? And if it is a standalone venture which is coming up for the first time into existence, in that situation how to treat the losses, right? So for example, there are the two entities. One is a project by the existing firm, right? So firm is existing and the project is new, and this is owned by the firm. So what action has to be taken in case of the losses? For example, the project incurs losses, which is what natural. Initially the projects incur losses and firm is also incurring the losses. So both are losses. So this project loss plus firm loss, you have to add it up, and total loss you have to defer it maybe for the tax savings against the profit in any particular year. In future, when there will be any profit to the firm, maybe to the firm as well as from the project both, or maybe to the firm there is a sufficient profit that it can even say set off the losses of the existing or the newly added project also. In that case we will pay the taxes. But at the moment, because project is also incurring losses, firm is also incurring losses, so we have only option is that we have to defer the tax payment. This we have no tax payment at all, and we will have to defer it maybe for the situation when the profit will be there. Against the profit these losses will be adjusted. After that, if there is any profit left, on that the tax will be paid by the government. So basically in this situation, because both the entities are incurring losses, so this loss will be used for say setting up of this loss against the profits of the future years. So under the set off and carry forward of the losses, there is a chapter in the Income Tax Act, and under that chapter we will have to use these losses for setting it off against the profit of the firm whenever the firm earns the profit. But at the moment we have to treat it as a loss, and we have to because both are incurring the loss, so we will have to means not to use it for any tax purpose, anything, because there is no tax liability on the firm. But whenever there is a profit tomorrow, we will use this loss for maybe reducing our tax liability. Second situation can be incur the losses. Project incurs the losses, but the firm makes the profit. So in that case, this loss of the project will be adjusted against the profit of the firm. So what will happen? So this will reduce the tax liability of the firm, because against these profit you are making these, adjusting these losses of the new project. You will be able to take the advantage of the tax savings in the year of the loss, because profit is not a total profit, because total profit you are going to work out not the project wise, you are going to work out the profit for the firm as a whole. So 4 projects are giving you the profits, one is giving you the loss. So total profit minus loss of the new project will be the finally the taxable profit. On that we will have to pay the tax. So it means because of the loss in the project, we will be able to make the tax savings, and we will be use that loss for reducing our tax liability of the firm. There is a situation, for example, when the project makes profit, new venture makes the profit, but the firm incurs the losses, right? Firm incurs the losses. So what can you do? Even the profits of the project will ultimately turn into the overall loss of the firm, because loss of the firm is more than the profit of the project. So in overall, the firm will end up with the loss. So again, you have to defer the tax payment, or you have to use these say losses until the firm makes the profit. And when the firm makes the profit, so you have to say adjust these losses against the profit of that particular year. And after that, for example, if any profit is there, we will have to pay the tax on the remaining profit. And for example, if both are making profits, then it's a very good situation, win-win situation for the firm. And naturally, you have to pay the taxes in the year of profit, because both are making the profit. So total profit of the firm, ultimately tax will be paid on the total profit of the firm. So the profit of the project will be added into the profit of the firm as a whole, and the firm as a whole will be paying the taxes to the government on the marginal basis. Whatever the total tax liability of the firm works out to be, out of the total, or maybe because of the all 4 or 5 projects, total projects will be owned by the firm. So total investment is made by the firm. Firm is the owner of all the 5 projects. So as a sum total of the profit of all the 5 projects will be the profit of the firm, and out of that profit the taxes will be paid by the firm to the government. And for example, if it is a standalone, it's not existing at all in the market, it's for the first time, it's a standalone investment. In that case, what will happen? It will incur the losses initially. That is what natural, because we all understand that initially up to 3 years, any new business incurs the losses. Maybe at the end of 3rd year or in the 4th year, it comes or reaches at the break-even point, and after that it starts giving you the profits. So initially year, first year, there is a loss, right? So what we will have to do? Defer tax savings until the project makes the profit or gives the profit. You have to not to pay any tax, because we are not earning any profit, and tax is always paid on the profit. So we are not earning any profit, the project is not earning the profit. So you are incurring a loss. This loss will be preserved, and we will have to use it against the profits of the projects in any subsequent year. So all the losses of the previous years have to be adjusted against the profits, and on the remaining profit of the firm we will have to pay the tax. So we will have to defer the tax liability till the time the firm makes the project makes the profits. And all these losses, because there is a loss in the first year, loss in the second year, loss in the 3rd year, so no tax liability is there. And whenever we start earning the profits, these losses will be adjusted against the profits of the future years. After that, if any profit is left, then the tax will be paid to the government, or no tax liability, or maybe less tax liability. Whatever the tax is payable to the government, accordingly the taxes will be paid, right? So this is the treatment of the losses. And next thing is the consistency principle. Next thing is the consistency principle. So the consistency principle says that cash flow and discount rates. Consistency on what? Consistency principle says that cash flow and discount rate applied to these cash flows must be consistent. So number 1, you have to take the cash flow. Second thing is the discount rates. You have to apply the discount rate for discounting the cash flows to calculate the present value of the cash flows. So it must be the inconsistent, say, with the investor group and the inflation, right? So the cash flows and discount rates must be consistent with respect to the investor group and the inflation. So first we will talk about the investor group, that how you calculate the cash flow which is consistent with the investor group. And normally when you talk about the investor group, we talk it as that, for example, all the investors are taken together. All the investor cash flow to all the investors, if they are taken together. Who are all the investors? Number one is the equity investors, who could be the promoters, who are giving the equity to the firm. Second are the lenders. They are giving the loans to the firm, or maybe they are lending money to the firm. So in the form of the debt, you call it as. So you have the two sources of the funds. One is the equity, and then it's coming up as the debt, equity plus debt. So when you are calculating the cash flow for all the stakeholders together, that you are calculating the profit after tax, and in that profit after tax you are not maybe subtracting from that profit the interest component, because interest component will go to the debt providers. So interest is not subtracted at all. So profit without interest, so that is a profit after tax you will calculate, and into that profit after tax you will add up all the non-cash expenses, and finally that net cash flow will be available to us. So since the interest has not been subtracted from the profit after tax, so it means that cash flow belongs to all the investors, both equity as well as the debt suppliers, means the lenders. So accordingly, we will have to discount those cash flows, and for discounting of the cash flows, what is the discount rate? You have to use it, weighted average cost of capital, that will be your discount rate, because capital is coming in the form of equity and in the form of the debt. So equity also has its own cost and debt also has its own cost. So the discount rate means when you talk about the R, right? So you will say that the cash flow, for example, CT in any particular year, and you have to discount it by 1 plus R. So this R has to be WACC, weighted average cost of capital, because we are considering the cash flow to all the stakeholders, all the fund providers. So in that case, weighted average cost of capital has to be used as the discount rate. And for example, if it is only to the equity shareholders, means the profit after tax, whatever the profit after tax is given to us, from that profit you have already paid the interest to the debt providers. It means after that, whatever the cash flow is left from this cash flow belongs to the equity shareholders only, because debt obligation has already been paid for in the form of the interest, and PAT calculated is after the interest. So this belongs to the equity shareholders only. So for discounting of this cash flow and calculating the present value of that cash flow, you have to use the cost of equity only as the discount factor. Means this R would be only the cost of equity and not as the weighted average cost of capital. Similarly, in the inflation, say consistency with regard to the inflation, when you want to consider the cash flows, whether you want to take the nominal cash flows or the real cash flows. If you are taking the nominal cash flows, then you have to use the nominal discount rate. And if you are using the real cash flows, you have to use the real discount rate. Difference between the nominal and real is, in the nominal there is no adjustment for the inflation, right? Whatever the cash flow is coming to us, that is, say, inclusive of inflationary effects, and we are not calculating the real cash flow after subtracting the effect of the inflation. So it means no adjustment for the inflation has been done in the cash flow. So when the cash flow is nominal, discount rate also has not to be inflation adjusted. It also has to be nominal. So nominal cash flow has to be discounted against the discount rate, which is a nominal without adjusting for any kind of the inflation. But if you have adjusted the cash flow for the inflation and calculated the real cash flow, then the discount rate will also be real. So in the normal course for our analysis, for calculating the cash flows and discounting the cash flow, we use the concept of the nominal cash flows and nominal discount rate. So we don't use the real cash flows and real discount rate. We always use the nominal cash flows and nominal discount rate. So whatever the cash flows we are working out, whether it is for all stakeholders, debt and equity, or it's only for the equity shareholders, it is a nominal cash flow, and it has to be discounted at the either weighted average cost of capital or cost of equity, but that discount rate will also be nominal, not the real, not adjusted against the inflation. So this is the consistency principle. So we have to be very consistent with regard to the investor group and inflation, and then finally we have to calculate the cash flows, and we will have to discount them to calculate the present value of those worked out cash flows. So, this is all for today for this class, and in the next class now we will see here maybe a worked out illustration that how the cash flow is normally worked, that how we take the cash outflows, how we take into consideration the cash inflows, and how we calculate the terminal cash flows, and finally the net cash flow. So, we will see one illustration here already done, and then we will discuss the say relevant other things, and finally we will move in the in the subsequent lectures about solving a illustration ourselves and working out the cash flows ourselves. So, that will be done in the later lectures. For the moment we will stop here only with the consistency principle, and rest of the things with regard to the estimation of the cash flows we will discuss in the next class. Till then, thank you very much.